Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang, and there's two Peters for the price of one. I'm joined again by my fractional CFO, my friend, my basketball pistol Pete counterpart, Peter Baldwin, to go into our second episode of creative financing, and this time in practice, replacing cash with structure. Peter, thank you for joining me.
My pleasure, Peter.
Everyone who's joining this episode, go back and listen to the episode we just did. We'll call that our segment 1. This is segment 2. In that first episode, we broke down how deals actually get funded. And I think the big takeaway was capital doesn't create deals, structure does. So now I want to go one level deeper. And I want to kind of use the billable hour of Peter Baldwin to be at your disposal, listener. Because when people think of, and they hear creative financing, they think it's kind of gimmicky. You have folks talking about creative financing in subject to in real estate, creative financing in M&A transactions, but they don't realize that it's something that really sophisticated buyers do. And in reality, you're aligning what you pay for with what the business is going to provide you in regards to performance. So Peter, when you hear creative financing, what does it actually mean to you?
Well, I think that term gets misused a lot. People assume it means unconventional or complex, and it certainly can be. But in reality, it typically is logically designed to match the structure of the deal to the underlying characteristics of the business to get a deal that actually works in context with the asset you're acquiring. If something is predictable, you can attach fixed recurring obligations to it. If something is uncertain, and obviously agency work often can be, you shouldn't be paying for it up front. You should be linking the consideration for it to the quote unquote period of performance or the period of risk mitigation. Uh, you know, I would say that creative is just disciplined by or informed by the structure and the nature of the business that you're acquiring.
Yeah, and there's a key distinction there. When we think creative, it doesn't mean clever. It means that we're being disciplined in our measuring and identifying of risks, and then we're balancing that until those risks really get resolved. We talk quite frequently about risk registers, the discipline of a risk compliance department going through and saying, here's all of the risks we need to mitigate in the business or in this opportunity, and then just going one at a time, incrementally, and saying, how are we going to mitigate it? Who's the specific person responsible? What's the consequence if we don't? What's the severity of this importance relative to the opportunity? And then aligning the structure with that. In our world, in agencies, especially in agency deals specifically, there's a lot of things that look stable, but actually they're not. Maybe you can unpack that a bit. You've seen under the hood with me, both in due diligence, but also in the fact that you are an advisor as a fractional CFO to so many of these founders. What are the attributes that make these businesses risky or have more risk than many of the founders are aware of?
Well, I'd like to first comment on the notion that creative doesn't mean clever. I like both those terms, but I think a better term is insightful or responsive. It takes the attributes of what it sees and what you see in your diligence, and it designs the deal around those things. You might see recurring revenue, you might see long-term clients, you might see strong margins on the surface, but as you get to the risk underneath that, you see client concentration or a lack of assignability in contracts or reliance on key personnel, like the founder or somebody who doesn't have any equity incentives at all in that situation and may very well bolt at the first opportunity if you don't structure your transaction to account for those things. There's also a lot of entities have or companies have high variability project-based revenue. And all of those things, they may not show up in the financial statements directly. You have to dig for them. You can see what it looks like a very healthy P&L with a consistent growth pattern, but when you start to decompose the revenue, you see, that there's one client who's 55% of the revenue, or that every single bit of new sales has been tied to this one person who is the engine for sales for the whole company. And those are risks you have to structure around, and that's where deal design comes into play. And it's not just creative financing, it's creative deal structure.
Yeah, the thing that we're labeling this episode, yes, is to get your attention. Right? We said creative financing, but Peter emphasized the key attribute we're focused on, which is designing a deal structure that is appropriate for the risk profile of the asset. And that is a disciplined, sophisticated buyer approach to a seller, not some aggressive, I'm just coming in and offering half because I can, which is
Incredible.
kind of, yeah, it's kind of the way this is received in the marketplace. People at our, you were with me at this. We were in Southern California at the Agency Acquisition Exit Lab, and we had a broker present. And I think his reaction to one of our mentees who was talking about a creative deal structure was, you're one of those bottom feeder buyers. And I think there's just this stigma, this idea that if you use creative financing, that you're cheap. You're not trying to deploy capital. You're not trying to do investments. You're not trying to buy companies. And what we're kind of arguing is there's a time and a place for creative solutions to get a deal done. And in your experience, you've seen creative approaches to massive deals, not just tiny deals. So maybe unpack that for the listener who didn't get to earn those trophies behind you on some of those transactions.
Sure. So, well, my background, my career after my MBA started in investment banking and specifically in corporate restructuring and turnaround work. So I was regularly challenged with finding deal structures that dealt with existing limitations of existing deal documents, where you had to layer in capital to a structure to rescue a business, but you had to work within the parameters of the existing debt documents, lending agreements, possibly shareholder considerations or difficult, parties of interest. All of those things were, um, areas of potential challenge. And my early career was essentially built entirely around finding ways to deal with those difficult parameters. And I did deals for up here. The smallest deal on this list is, it's less than $1 million, and the biggest is 18.5 billion. And all of them required some element of creative deal structure to deal with multiple constituents and parties of interest. Because the other thing you need to remember is that when you do a transaction, you're not just negotiating, even if the company that you're acquiring is owned by one person. They may be your direct counterparty in the negotiation, but there are all sorts of other stakeholders that surround the transaction. And you have to design the transaction with those stakeholders in mind. You and I worked on one of the first transactions we did together was an ownership group and a management team that really were not aligned. Right? And we had to design a transaction that gave the ownership group what it wanted and gave the management team what they were looking for, and to convince both groups that it was okay to trust the other group, which trust had broken down, and to go ahead and make that deal work. And that's a perfect example of, yeah, we weren't negotiating. They were the management team didn't have the ability or the power to buy or sell the business, but their buy-in to the transaction was critical to the success of the deal. And so the deal had to be structured in such a way as to consider multiple stakeholders, and it wasn't just one manager. There were like 5 or 6 key personnel that had to be retained, and a whole team below them that had to be incentivized. And then there were key clients on the other side who had to be wooed, for lack of a better term.
Be confident in the go forward stewardship of the
They had to
business.
be
Yeah.
convinced that the business was in good hands and that it was worth renewing or assigning their contract to the successor organization. And obviously that ended up working out. We got that deal done, and and then subsequently exited from the transaction several years later, with great success for essentially all parties involved. It was
Well,
it
I want
challenged
to,
time too. It was really difficult to.
yeah, I want to unpack the clever component. Yes, you and I, especially in tandem, are great at finding ways to structure a deal to get to the outcome of the stakeholders involved. We both do it quite naturally. We both do it extremely well, and then when we do it together, the potency of that is severe. That said, I think it stems from our ability to not be put off by the risk profile. But you and I both have a natural curiosity when we find risk. We don't get immediately turned off, which is weird given that you're a CFO, for goodness sakes, Peter. Your objective is risk mitigation. And so like I want to make sure the listener knows that although there's people like us who have vast experience and have transaction volume that gives us the pattern recognition, the confidence to go into these and kind of piece it together, that's not the thing that's required. It's required just to not look at it in a binary risk equals bad. It's risk equals opportunity, and you figure out how to get there.
Well, and you figure out how to structure so that the reward and the risk are in balance, right? You don't want to take a risk that doesn't have a commensurate payoff. And you don't want to, you want to mitigate each and every risk, and you want to make sure that you've taken the appropriate steps to manage it and that the proverbial juice is worth the squeeze, right? I don't want to give listeners uh, the implication that or the sense that I'm some swashbuckling pirate who has never met a deal he didn't like. I have an appetite for risk because I've spent my whole career structuring it and managing it for clients. That doesn't mean that I'm inherently risk averse. My approach towards risk is governed by my understanding of the mitigation of that risk and the ability, or I should say, the reward that comes with the acceptance of that risk.
Yeah.
And our goal in a transaction is to manage the risk in such a way that the reward outweighs the potential downside risk, and that we've structured in a way around it that we're not hung out to dry if that risk proves real.
And they have proven real. Like many of the deals we've done together, there's risks that even if we do our best to mitigate, they still show up. There's still problems and they still need to get dealt with. The reality with business is it's always bad. It's always hard and you're always figuring things out. Nothing changes when it's a deal. It just the component parts are just not something that exists within the business today or yet.
Yeah. On the last episode or the last segment, I believe I mentioned the acronym TANSTAFL. There ain't no such thing as a free lunch. It applies here too, right? You don't get the reward without accepting the risk. The question is, can you reduce the price of that free lunch such that the value is far greater than the potential downside.
Yeah, 100%. You don't get to walk away from risk. You have to structure around it.
Right. There's no such thing as a risk-free transaction. If it was, there wouldn't be a negotiation on price. You wouldn't need to do there's no such thing. Every transaction comes with execution risk and inherent risk and market risk. And there's a reason why we keep risk registers, right? We're trying to understand all the potential ways this could go wrong and address it. And our deal structure is a critical component of how and why we keep that risk register.
We were talking about the creative financing mechanisms available to us in episode 1, and we were recommending kind of 2 deferred compensation structures, one being a seller note and the other one being an earnout. So let's break down one of the biggest mistakes you see when people overuse or, let's say, not properly construct a seller note.
Well, there's a lot of ways a seller note can go bad. One is having amortization or payment schedule that's too aggressive. There doesn't have any flexibility built in. There's multiple ways to do that, right? Too aggressive, the payments are too high, right? Flexibility, there's no way for you to get a forbearance or to tie it to business performance or to delay it, even if total quantum of payments doesn't change. The ability to elongate that if the business is underperforming and stretch it out over a longer period of time is a common thing that is omitted.
Well, let's label that. So far too often, we both see a seller note used as a fixed obligation versus a flexible obligation. And to your point, yeah, 100%. It's you have the ability with that type of note to build in attributes that help you traverse the future uncertainty of a business. Use it.
Sure. And there are other seller note-like instruments that kind of work on that continuum in terms of flexibility and customizability. But seller note is obviously the debt obligation version of that. And there are a litany of ways we can structure a seller note to to get that level of variability built in. Now, if you think about the other end of the spectrum, people think about an earnout or an equity roll, but let's talk about earnout for a second. The earnout is entirely contingent on performance, and that's a negotiated set of metrics where you have to get to. There's no reason why you can't take that same sort of negotiated set of metrics and embed it into the seller note. So, the sellers, what are sellers looking for? They're looking for the maximum amount of certainty what they're getting, right? Unless they have an appetite for risk that is commensurate with yours, there's a reason why they're selling their equity. And that's not all sellers, right? We worked with sellers who took a big roll portion. They wanted to keep their money on the come line at the craps table, that is the company, and bet on the future. But a lot of people want to pocket their gains and have certainty they're going to get paid. And the key is how you mix those two things in the negotiation with an amount of certainty of the quantum of consideration for the seller with the variability you might need as the buyer to address any kind of vagaries of the business or exogenous market shocks or any other thing that would materially move the performance of the business in a way that would make paying the seller note on a regular interval at a fixed amortization schedule unpalatable.
Yeah, so the distinction is seller note, certainty, earnout, variability, and the choice between those kind of ultimately reflect the level of risk.
Yeah, but I would also say that's a continuum, right? It's not like there's at one end there's hard and fast must do everything according to the calendar says it's the first of the month, therefore the payment is due, and there is no forgiveness and what have you. On the other end, it's all on the come line, and you are betting the whole pile of consideration on the future performance of the business. You need to find someplace in that continuum that works for both parties.
Okay, this is an important distinction. So if you're selling a business, you want as much cash upfront as possible. So it's a fair position to take. And then when you're buying a business, you want to mitigate risk as much as possible. And so you want to retain or defer as much as possible consideration tied to future performance. And so back to this array, the spectrum you're describing, this is where I think the creative label gets inserted. It's the things you have to find and put together to bridge that is what creates deal design and creative financing. What do you think gives you an advantage over maybe someone else when approaching deal design? Because this is important ways for us to give feedback and have the listener set an expectation for themselves.
Well, I like the Indiana Jones line, right? It's not just the years, it's the mileage. I have not just been around for a while, but I've done a lot of transactions. I've seen a lot of quote unquote creative financing or creative structuring solutions. I've not just seen them, I've executed them. And I understand kind of the whole universe or not universe of financing options or structuring options. And I know their pitfalls. I've seen enough in this space, in the market for corporate control space, that I have a whole lot of arrows in my quiver, so to speak. Lots of things I can bring to bear, ideas I can bring to bear that could potentially solve a problem. So where other people see obstacles, I can acknowledge the obstacle, and I have a resource of here's 5 ways we solved that problem in the past.
Yeah. I recently saw a sell side advisor, someone who helps businesses remove discount factors prior to going to market. He did a post on LinkedIn and said, earnouts are not creative deal making. They are a risk transfer mechanism. They shift the post close risk from the buyer to you. You can tell who he's speaking to in this. And his whole,
Not surprising.
yeah. And his headline is, when the term sheet says 60% cash on close, 40% earn out over 24 months, what it actually means the buyer is committing 60% and the other 40% is contingent on targets. That is not deal structure. That's a liability dressed as a headline number. Price and structure and terms move together, but terms are where the real money is won and lost. If you're heading into a negotiation, you need to de-risk your position. And so he's pushing 90% cash on close. I commented back, Peter, in a way that will not surprise you, that I said this was a little bit too broad of a generalization, that unsophisticated sellers doing a deal with an unsophisticated buyer can equal bad outcomes, with or without earnouts. And a well-designed earnout can absolutely be a useful risk mitigation tool and a practical way to bridge a purchase price gap, especially when it's carefully thought through with upfront and structured payments and flexibility, so future disputes can be avoided and resolved quickly. And then I reference that in some industries like ours, and professional services being a quite frankly obvious one, there is even very reasonable expectation around earnouts because of client retention risk, transition risk, seller involvement post-close. And so the take that earnouts are the buyer just pushing risk onto the seller purely like, show me who you paid to get your valuation. I'll show you which direction your valuation is leaning.
Absolutely. I think of the earnout as the Missouri Compromise, right? To make an historical reference, not in the specific historical context, but in the show me version. Because at the end of the day, an earnout is essentially the buyer telling the seller, show me you deserve that, right? Show me your business is worth that much. Because I believe there's a whole lot of risk, and you need to show me that there isn't. So while is it a risk transfer? I mean, I can see how a seller advisor takes that position. It's not an unreasonable position to take if you're a seller advisor, especially if you're earning a percentage in terms of the value you get for your buyer. Oftentimes, the earnout is carved out of that. So they have an adverse incentive to object to any contingent consideration in a deal. But if we're looking at a situation where the only way to bridge the gap between the buyer and seller is an earnout, well, then that's a problem
Exactly.
that you need to address, right? Like this is an unaddressed risk. It is a risk that that we agree has a price, right? That price is that this entire chunk of EBITDA we think is at risk. Your retention of that revenue, margin, EBITDA, whatever the specific component of business performance is something you need to show me,
Yeah.
right? And I'm not going to pay for it just because you say you accuse me of transferring the risk. It's like at some level my response is you're damn right I'm transferring the risk because this is unproven.
Well, you're transferring the risk to me. The risk already exists. So the argument that the buyer's transferring the risk back to the seller, no, it's going back to where it was. The risk is in the business being acquired. It's a systemic or intrinsic risk. And when the buyer shows up, the seller is trying to, let's just say, not emphasize the risks with they're not verbose. They're not out there saying, here's all of my problems, here's everything that we need. They're trying to maximize their position. So this is where communication really matters
It's
because if
very rare that a seller comes out and goes, open kimono and says, here's all the warts on my business and all the ways things could go wrong. And you should pay less for me because no.
yeah, and it's fair to say if you did do that, buyers would take advantage of you, just like there are sellers that if you go around and say, we're going to just write a check for a significant, like 90% cash on close with obvious risks in the business, that you're going to lead to an environment of dispute and litigation because that's just the assumption is rosy, favorable that all things are going to be good.
Yeah, I mean, I don't know what to say about that, right?
Well, I'll say, like, I don't trust your business. It's fair that someone pushes back. But if
No, I 100%
if
agree.
you're in the position that if this performs, you make more than a fixed deal, now that you have to align incentives. And the key thing is just making sure that our incentives are aligned. You don't want to ask someone to be burdened with the ongoing risk of the business they're trying to sell without any incentive to be burdened by that risk.
It's value for money, right? The fact is, though, like people don't buy historical results. Historical results give you confidence in the likely sustainability of future results. But at the end of the day, to use a term that I really should avoid, at the end of the day, we're buying the future performance of that business. And if there's uncertainty about that future performance, then we need to mitigate or manage or structure a deal around the risk. Now, I'm not actually a huge fan of cash-based earnouts, in part because they oftentimes they create a pretty sizable friction.
Incentivize the wrong behavior, yeah, and they're incentivizing the wrong behavior.
They often don't incentivize team play. Like if you're buying a pool of assets into a company and that seller is supposed to be focused on the growth of the whole company, but their earnout is linked to only the performance of the specific assets or the brand or whatever you want, the line of business that was acquired, then they don't have incentive to be a team player. They're not going to focus on things, or they don't get paid, right? It's the old Peter Drucker line. So show me what get measured, what gets measured gets managed. Well, it's the same thing for earnout, right? What gets measured and incentivized and compensated gets managed, right? And everything else gets pushed to the side. Oftentimes, better deal structuring includes, an equity linked type instrument that gives that same pile of that same total consideration potential, or even superior if the business performs, to the seller, but in a way that aligns it better with the overall performance of the business. In addition, the other problem with earnouts from a buyer perspective is that you can create a giant cash outflow at a future point in time that, if you haven't designed the earnout correctly, was not self-financing, right? In theory, every month that if you have a 24-month earnout and every month that seller gets closer to earning that earnout, you should be putting away 1/24th of the earnout as a set aside. That's not a great use of capital, right? So, because, essentially the idea that I'm putting away whatever that earnout is, just sitting on the side doing nothing, or maybe it's earning a couple percentage points in treasuries or money markets or what have you. But there are better ways to design a deal to align the upside potential for the seller in the future performance of the business in a way that doesn't create a liquidity hit for you at a defined period or periods in time, and doesn't disincentivize the seller from properly integrating with the rest of the business or focusing on the overall growth, or things that, or they're resource hoarding specific members of the team, or that are not bringing in outside resources to properly serve the client because they don't want to increase the cogs of that specific deliverable in a way that would impact the EBITDA calculation or the gross margin based calculation of the earnout. That means they don't get their earnout payout. And then I've seen that recently. I saw, not specifically the bad behavior, but I saw an earnout that missed by less than like 1% on the performance target. And, to the buyer's credit, the buyer told the seller, we acknowledge that you were really, really close, and we want to give you value for that. It's not, some of that, a very small percentage of it's going to be in cash, and the rest of it we're going to give you in an equity instrument that aligns with the future performance of the business. But it was, you know,
I
uh,
mean, earnouts
debating the
being missed. Yeah, more earnouts are missed than they're hit.
I would argue that earnouts being missed is the rule, not the exception.
Yeah, and the reason for
Another thing, Peter, oftentimes, and I not necessarily in this space, I've also done transactions in numerous other spaces, but I've seen situations where, and I think you'd agree this is pretty common, where the seller often, the sort of the median deal, the seller leaves the business before
yeah
the earnout is achieved and loses the earnout just because they didn't feel aligned or they weren't on board. Earnouts are fraught with friction
yeah
intrinsically.
they're quite easily predictable. The vast majority of transactions with successful earnouts that I've seen are ones where the business and ongoing commercial intentions of the transaction are prominent, not just the financial engineering. And so whenever you have good financial engineering of a transaction with the right levers in place, given future expectations, independent of the qualitative attributes of business, culture, individual human dynamic, it fails with greater predictability. Just like that example you gave, there's many instances where founders walk during the earnout period because it's a different thing than the business when they owned it. The day to day, their impact, their control, what they were sold a bill of goods that they contributed to, that didn't align with reality.
Even if they weren't sold a bill of goods, sometimes the culture shock is just significant, right? You can't deny the fact that when you acquire a business, no matter how much you want, you're interested in sort of certain core strands of the DNA of the culture, that culture does not survive intact ever,
Yeah, it shouldn't,
right?
and it shouldn't, by the way.
It, if it does, you're not really integrating. You're not really, you didn't, the whole is it's not a whole, it's multiple separate parts. And if you have a non-integrated, like different, a conglomerate type approach to building a business, then maybe that's okay. But for a lot of sellers, That's not what they're envisioning. They're envisioning a situation where, hey, my culture, my people, nothing changes. I feel like I still have the same level of agency and control. And those things just, they never prove out. And so sellers are very often disillusioned, in part because their expectations haven't been managed from the outset, right? The deal conversations, they don't communicate the vision for the business in a way that acknowledges the reality of the intermingling of the cultures is going to change them both, right? And this is often a really hard one for sellers is you're not the decision maker anymore. We respect
And
your
although
opinion, but you are not in charge.
Although that sounds like a relief when it's paired with and the stress of the things that used to be under your decisions are no longer yours, it's actually not the reality. And so whenever you have unsophisticated buyers who do not know how to set the table well for their sellers, you're going to lead to this misalignment.
We talk about more broadly, right? With rights come responsibilities. Well, the converse is true as well. With the removal of responsibilities comes the removal of rights, right? If you don't have the same level of risk, agency, et cetera, like if you're not taking that equity risk and that stress, well, you don't get to act like you're still the equity owner, right? Or at least the majority equity owner. Those stresses have moved elsewhere, which means those rights have moved elsewhere. And if people don't have those perspectives shared with them in a way that they are fully understanding of, or at least reasonably well understanding of, then it's going to create friction as integration happens. As you build this new culture, this new enterprise together, causes issues. And these are all things that, I mean, it, it really
These
is.
are all things that go into the creative deal structuring that we've been talking about.
Yeah, you need to structure a deal so that these things are clearly understood and as early as possible, right? Because in some
Maybe
ways, people will tell on themselves if they won't agree to these kinds of deal structuring elements. It potentially is an identification of somebody who's not a good cultural fit because, or will be an integration headache because they can't give up the control, or they won't align with the idea of if we all win, it's good, right? So you need to get somebody who is potentially a cultural cancer who is all about their own reward, and even their own people may be unhappy about that, about continued involvement in the business.
that's so important. By the way, let's double tap that. It's so important in the honeymoon period of deal making to talk about the divorce or the what would happen if it's divorce. If you defer all of the really uncomfortable bits to the purchase agreement or don't even have the discussions at all until after close, you're going to end up with a bad outcome.
I mean,
Now, we're not saying be contentious the whole time, but of course, it's important that these things come up early.
I would say that an asset purchase agreement or an equity purchase agreement is a combination of a marriage contract and a
Divorce.
prenuptial agreement.
I look at it as also, yeah, it's,
I mean, the prenup essentially contains the terms of the divorce that both parties agree to, right?
yeah, yeah.
And the marriage contract includes the sort of governance provisions that make clear, right, that here are my rights and my responsibilities, here are your rights and your responsibilities, and they are different in these ways because we have pre-negotiated them. Obviously, in a marriage, you want things to be more equitable, at least in principle, but in an equity transaction or an asset purchase transaction, they are not equitable, right? There is a buyer and there is a seller, and sometimes, that is, there's an ongoing equity role, and sometimes there isn't, but it's important to have those frank discussions early because people will tell on themselves as to whether or not they're going to be a good partner. And you will
Yep,
see those red
100%.
flags, those business relationship red flags will pop up in that conversation. I used to, when I worked in investment banking, I used to do recruiting for my bank. And I would tell people that when I would go back to my business school to interview, that the way in which you experience the interview process is the way in which you are likely to experience the culture and the life on the job at the bank. Because the way they treat you in every interaction leading up to you, in some ways, it's the best you'll ever be treated, right? Because they're in the honeymoon or the wooing phase where they're trying to get you to sign on the line that is dotted, and they're very interested in figuring out if you're the right person for them. And once you sign, you've essentially kind of set the floor or the ceiling or both for how you're going to be treated in that relationship or how you can expect to be treated in that relationship. And behaviors we had this conversation recently about it in a specific client or acquisition context where the seller had a personal circumstance that they asked for essentially an 11th hour change in the deal terms to add a material amount of additional cash on close because they had a family circumstance that they needed to address. But it really was kind of, whether it was sign of an unsophisticated seller or professional immaturity, there's a number of different ways to look at it, but we had to essentially both counsel the client to take a hard line against that, not because we wanted to be unsympathetic to the seller's circumstance, but because we didn't want to set the precedent of everything we just negotiated is optional. So we worked with a client to figure out other ways to help that seller realize additional liquidity through other incentives or potentially some kind of other agreement. And I don't want to get into specifics because,
We'll keep it. We're getting pretty specific as it is. So,
but we wanted to create some flexibility without modifying the core deal terms in the way the seller had asked. And that's because we didn't want to set up this notion that the boundaries are not boundaries, right? That the rules we agreed to up front are not rules.
yeah, and the line that I so often repeat to founders is every interaction you have with a seller is due diligence. Everything they
100%.
say, how they say it, everything is due diligence. And it's far too often you're looking at the forest and you miss the trees and vice versa. If you get it too granular
Absolutely.
in these businesses, you miss it. And you're just like caught up in deal fever, you're caught up in the momentum. Now, I will say I see more deals killed from that because they think a yellow flag's a red flag without actively working through the risk that they're identifying. But when you see retrading, when you see this lack of transparency, when you see things that just are off, you really need to pay attention to those in your deal. Because every single time you talk to someone, you're learning something about them as a representation and disclosure, whether or not it's documented.
It's the same thing when you're interviewing somebody for a job, right? And
Same
as a job,
exact thing.
it is every interaction is an interview. There's nothing that's not an interview. All right. It is diligence for one party or the other or both in all cases. And when you're doing the same thing in buying a company, right? The fact that they took this long to give you access to their to get you detailed financial statements tells you data point, right? It's
Or they
either
say they're not actively in the business working operation, but then you take them to lunch and they check their phone and check an email all the time.
yeah, there's a whole
It's
different
like,
the fact is that everything is a data point in this situation.
yes.
Every interaction provides you additional data points that you need to consider. What does it tell me about this seller, about this company, about what
And
I might be
creative
buying?
financing allows you to still get a deal done with those things present. Let's be clear. Like as long as we can structure the deal in a way that protects the business, that's the opportunity. So I'm going to give you an illustration because I don't want to waste this brain power that I have here. Let's walk through an example. You often hear me say, "What are you doing this month, this quarter, to add 300,000, 800,000 of EBITDA to your business?" Promise you, you probably don't have an initiative or conversation that's contributing to it. But let's say this business does have it. We're looking at an 800K in EBITDA agency to acquire.
Mhm.
Peter, well, okay, walk us through that example. We are currently operating at 2.4 million of EBITDA. We have a prospective agency in front of us at 8K. Walk us through what are the things we typically see when that ends up being our equation.
Well, I mean, first of all, obviously the algorithm that you and I, or the rule of thumb I have is that you should essentially acquire things that are zero point 0.3 size of your business. So that's roughly the it's 800 on 2.4 is about a third, close enough. Um, you walk through that though, and we're going to start looking at details of, well, what's in that 800. We want to know what's your client concentration, what percentage of your revenue is tied to that client, what percentage of your time or your EBITDA. Because here's the other thing, right? Just because let's say that you have an 800,000 EBITDA agency, and let's say that it does 40% margin, so which should be juicy, but nevertheless, let's say that so it's 2 million of revenue, and 40% of that revenue is one client, so 800,000. But how much of your EBITDA is that one client? Are we able to serve that client with just a couple of people so it's super high margin? So if I took that one client out and I looked at the rest of your business, what happens, right? I mean, not only because we want to isolate what happens if I lose that client, but also we want to understand, is your profitability, is it just tied to one client? Right? What if you've got the other 1.2 million of revenue you've got in this 2 million illustrative, how much are we making on those? Do you even have the data to tell me? Because at that
And
size, you're
let's
oftentimes at an inflection point where a company can really gather that data.
you're going a place which is whenever we've seen, let's just say, dense client concentration, the founder's always heavily involved in that account.
That's where I was going to go next is
Yeah.
how much of this business is tied to a single person, and how much, and is that person the founder, in which case we have to think about what happens when the founder leaves, or what happens um, when the founder walks. You've got to avoid heavy fixed obligations in that situation, because potentially 40% of your revenue is walking out the door if you and the founder have irreconcilable differences, right? Maybe that one client has been there for 10 years and it's always been serviced by this one person who's effectively the account manager for that client. And if that person walks, do you have any confidence the business stays? So in order to avoid that heavy fixed obligation, you've got to tie it to the risks associated with that single point of failure, right? That founder, which means lower upfront cash. You got to have, you can tie a portion of the note to, or you can give them a seller note, but I would link that to cash flow, right? If the business, sees a material reduction in EBITDA or operating cash flow, or it's a negotiated metric, but some negotiated metric that both parties can get around or get behind rather. And then you have to have a meaningful deferred consideration component, whether that's an earnout or an earn in or any one of a host of potential equity-like instruments that needs to be tied to client retention and performance and effective handover and retention, right? Where that person maybe year one, they're still first chair in that relationship, but they're bringing on the second chair and they're beginning to transition the relationship. And year two, there's a continued support as the relationship transitions because we've communicated to the client and got them comfortable that we've been acquired. I'm going to continue to support your account, but I'm also looking to step back my own obligations. I'm, parroting the seller here at this point, and I'm going to introduce a new resource or a new account manager into the relationship. I'm going to continue to provide support, but they're going to become your primary point of contact. My job is to support them as they do this and make sure that and then there need to be the normal kind of supportive communications. I'm going to continue to have an equity stake in the business. I'm going to continue to be involved. I'm going to, this person is going to be reporting back to me and the new owner about how this is going, and I want to make sure. But please, I need you to communicate through them in year two, right? And I'm over elaborating here, but these sorts of things are really important because
Yeah,
it's
the
the
comms
level
are.
of detail you have to have in the conversation with the seller about what it really means. I'm a University of Michigan grad, and Michigan recently hired the former coach of the University of Utah, Kyle Whittingham, as their football coach after he had originally announced his desire to retire at Utah, but then he got this opportunity. Well, he had a transition support agreement for the University of Utah football team, which included a smooth transition consideration. And the letter of the agreement was not as specific as the athletic director probably should have made it, because I don't think the athletic director envisioned that Kyle Whittingham was going to take the job as the head football coach at another school. And in the process, he was very upset because many of his players who had loyalty to him and several of his coaches who had loyalty to him said, "Hey, it's a new world of college sports. We're free agents. We're going to Michigan."
Yeah.
Well, the University of Utah was not happy with that, but they also had no contractual language to protect themselves. And so they ended up paying the whole bonus because
Yeah.
they had something in the agreement that said this is what smooth transition means in like brass tacks, bottom line, rubber meets road type of terms. And I use that example not only because it benefited my university and I kind of appreciate it, and I think it's funny, but also because it's a perfect example of what happens when parties define those terms or save them for later, right? They just had this amorphous smooth transition term. That's it. What
They
does success look like here?
you can tell that the exercise of what can possibly go wrong was not played. If you run through the scenarios, do the risks associated with the situation, worst case, and then you address it. We
That's happened in collegiate athletics, by the way. Also not happen in the agency space.
Yeah, at the end of the day, the structure reflects the actual risk, and you have to be able to identify that risk.
That
You
is
don't,
correct. You don't eliminate risk.
you never can eliminate risk. You price it through a structure. As a bonus for everybody, before we wrap, and we're going to have the next episode where we're going to talk about scaling with creative deal structures. How do you do things with deals in place already? I do want to unpack the secret of equity-like instruments.
Okay.
Your favorite thing. I can tell everybody, just full disclosure, Peter and I work on a lot of deals together, and I just sit back and watch like someone who knows the bit's coming. And he just brings this up, and I wait for it. It's teed up, it's like softball. And everyone's just sitting in awe when he talks through this. We've used it, we recommend it. Peter, unpack in our example of creative financing and deferred compensation balanced by risk. What does it mean by using an equity mechanism as a part of your deal stack?
Yeah, it's no secret between us that I'm a big fan of hybrid equity instruments, or there's a continuum of equity, right? From sort of just naked common equity at the tail end, right? Which is I am a shareholder who gets what's left over at the end. Uh, and there are a whole series of equity linked instruments that attach to that, right? Whether it's warrants, options, RSUs, there's a whole series of things there. But those are, and you can have them, they're mostly attached to a common instrument. A little further up the capital stack is the entire universe of preferred equity. Preferred equity has some of the elements of some of the flavor of a debt instrument without getting debt treatment, but it also has the benefit of being ranked ahead of common. So preferred equity is first of all, it's the venture capital instrument of choice as a general rule. When you get VC investment, it almost always comes in the form of some flavor of preferred, and there are all sorts of flavors of preferred. There is straight preferred. What straight preferred is, I rank ahead of the common. I get some level of preferred dividend. That preferred dividend is due no matter what. So it almost has a debt flavor to it, right? In that sense, except the debt's not amortizing. It's just I'm paying a 5% dividend per annum no matter what, right? That is more equity like. In fact, when I worked in investment banking, we used to have to go socialize deals to the ratings agencies to get those deals rated to sell to the investing public, or more likely institutional investors. I didn't deal a whole lot with retail. The rating agencies have sort of a hierarchy of the sort of debt likeness, which is a terrible phrase on my part, but it's how much like debt the preferred is behaving as, right? So they look at the elements, right? How optional is the dividend payment? Can I defer it?
Just to state in another way, it's how in conflict to our debt is this instrument?
Right. Yeah, but can I defer it? Uh, how many times can I defer it? If I defer it, ever is it accrued as a future obligation, or does it just go by the wayside? Right? Because there is a type of preferred instrument where if the business doesn't meet a certain formula for performance in a period, no dividend accrues on the preferred. So it's very much linked to the performance of the business. And if it isn't due in the future because of that, then it's non-cumulative, meaning unpaid dividends don't just sort of stack up as unpaid and get added to what you need to pay later. So there's a cumulative element to it.
And if someone's listening to this and goes, I've heard this type of explanation, but it was in reference to a promissory note or an earnout, it's because they do sound a little familiar.
Right. The way we've modified seller notes is to make them act more like preferred equity instruments that have these business linked performance elements to them. Now, the reason I like preferred equity instead of seller note instruments, is because if you have an existing financing vehicle in place, a debt instrument, you can put preferred behind it and structure around it in ways where the debt holder, the bank, the SBA lender, the whomever provided your financing, does not stomp their feet and say, you have broken a covenant because I said, there shall be no other debt but me. And you agreed to that. Now, it's not always true, but if you look at an SBA loan, or you've
Well,
got,
let's convert this into a question of one of our Slack community members. Mark asked if I already have an SBA loan because I bought a business. What are my financing options beyond seller notes and for future acquisitions?
well,
And
sure,
so this is one of them.
it is. And once you have SBA debt in place, you do get constrained, right? Because you can't have multiple SBA loans. And you also have debt service coverage requirements, right? Debt service coverage ratio, or DSCR. You may also hear this as termed as a leverage covenant. There may also be, and there's also an interest element to the DSCR. It depends. Different banks define it different ways, but the general idea is the ratio of cash flow to debt service has to be at a certain ratio. And if it falls below that ratio, they worry that they don't have sufficient coverage of their instruments going service requirements, right? Whether that's amortization, because of the
It
reason why.
predicts default rate. Put another way, it predicts default rate.
Thank you for simplifying. I was getting into the weeds.
Yeah. So, because if you have, let's use Mark, right? If you already have an SBA loan, the financing options beyond seller notes for future acquisitions are one is you separate it, use a SPV, special purpose vehicle, and you acquire that business outside of the original SBA borrower. That will help you avoid the DSCR that we're talking about right now. It's called ring fencing risk. Like they want to have access to the things that are contributing to their repayment. You have seller heavy structures where there's significant percentage in regards to earnouts, or what we're going to be talking about as equity instruments. You can bring on equity partners, although that's changing in SBA landscape because now they become part of the borrowing party when they become an equity holder. Earnouts. And this, there's cash flow recycling, but this equity instrument that you're really good at helping people understand is one of the best tools available to them. Why is that?
Well, there's a couple of things. I think one of the reasons why I like this instrument is because it has what's referred to as liquidation preference. Sellers anchor on the idea of I'm getting this much for my business, a number, right? They don't anchor on a multiple, although a lot of sellers start with a multiple, but then they think to themselves, my EBITDA is this, my multiple should be that. They do the math, and they say, this much X, this much EBITDA equals this much consideration. They circle that number in their head and they anchor to it. And so when you give somebody a common equity instrument, it's really not a number, right? It's a percentage. It's an amorphous future result. The thing about preferred equity instruments, and we haven't begun to kind of dig into all the other types of flavors of preferred equity instruments there are, but they all have one thing in common, which is what's referred to as liquidation preference. Now, bear in mind, the word preferred is referring specifically to the order of who gets paid first in a liquidation, right? And we talked about capital stack in the last segment, right? If you think about the foundation, it's the senior secured first lien lender, and then there's any junior lien lenders, and then there's any unsecured lenders, and then there's any sort of preferred or other hybrid equity instruments that fall in here, and then there's the common at the tail end. So if you think about how high the pile of money has to be for the common to get paid, it is the highest part of the pile. And so the value of the business, if it's only this much, it only goes to the secured lenders. If it's this much, the unsecureds get covered. If it's this much, the preferreds get covered. And if there's anything left over after that, it goes to the common. Preferred equity speaks to their idea of, I want a number. And you can say, okay, great. Liquidation preference, your claim value, just like a debt has a principal value, a face value of the debt instrument, is X. It's $1 million or it's 100,000, whatever you need to kind of fill that valuation gap in your structure. But it's subordinated to all the debt instruments, not only in terms of the liquidation waterfall, who gets paid first, but also in terms of the payment waterfall for debt. So for a debt instrument, if we don't meet the DSCR, or if we wouldn't meet the DSCR if we paid your dividend, you don't get a dividend for a preferred instrument. That's the way it's designed. But that's where the cumulative or non-cumulative or all the other ways in which you can design it. The other thing you can offer in this context is, and maybe this is a subject for talking about in a future segment, but is the convertibility or the participating nature of that amount, right? You can have a participating preferred, which is, by the way, very commonly what venture capitalists use, where you essentially you get paid off to the amount of the preferred, and then it turns into common and gets another bite at the apple and plays with the common. Now, as a buyer, I don't really like to offer that because it essentially is giving superlative returns to the preferred holder and much less to the common who I represent.
Said another way, we're giving too much upside in the transaction.
Right. If you can let them instead of getting paid cash.
Correct. Yeah.
That is a thing I like to offer because it aligns incentives.
Yeah. In our 800,000 in profit example, EBITDA, say we buy that 800,000 of EBITDA for 3 times, that's 2.4 million back to our 30% as our target add-on to our operating size. And then if I have a 60%, let's call it preferred equity consideration, which is rather healthy. I'm just using this as an illustration. That's 1.4 million, 1.44 million in preferred equity. And so let's describe the attributes if this was our deal structure. 60% in preferred is a lot, though it could be 40. What would we want to see as the how would we tailor this preferred instrument, and what do we typically recommend?
Well, first of all, I'm going to ask, why does it have to be one preferred instrument? You can also have various classes of preferred instruments. Right? You can have some that feel more like debt and some that feel much more like common equity. And
And I,
often we've done that. You can have senior preferred and junior preferred. You can have tiering, right? So you
yeah,
can
and I
literally,
this is important. I want to set it up and get back to it, which is sometimes the quality of the revenue is not the same, and therefore you structure the payment consideration. So the deal stack needs to be reflective of that. So you can use multiple types of preferred, especially if you're buying multiple types of revenue. So just setting the stage as that's kind of our situation here.
yeah. So we can debate what was the percentage that was tied to a specific client. It was 40, I think, in this
I think it
illustration.
was 40. Yeah, our illustration. So
So
the
you could, you could have a big,
60% of it in form of preferred, and then 40%, so it's weighted to that account size,
yeah.
is going to be treated differently.
You could have a junior subordinated, non-participating, convertible. There's a whole bunch of adjectives you can throw at that can describe that. But the 60% could be much more like a debt instrument, right? Where it pays a dividend unless there's a DSCR bump, a DSCR violation. You do a pro forma calculation that says if we pay the dividend, will we blow the DSCR? Right? And if the answer is no, then the dividend gets paid. You may want to build in a little cushion there. Like, if the DSCR is set at 1.25x, you might put the cushion at like 1.5. And just for those who are not familiar, that is essentially saying for every dollar of debt service, my coverage ratio has to be $1.25 in EBITDA cash flow, whatever the metric is. Usually there's a modified cash flow calculation, which is essentially operating cash flow with certain deducts and add backs depending on the nature of.
He's using proper underwriting etiquette, is what he's doing. Yes.
As somebody who's negotiated a whole lot of these, or for that matter, on behalf of the bank, both on
Yeah.
behalf of buyers, borrowers, and the bank over the course of my career, there's a whole lot of room for negotiation. Now, I can also tell you in those situations what the bank will and won't agree to, like as a hard and fast rule, because I've dealt with those credit risk management committees. And there are certain things that are just, no fly zones for them, but other things you can negotiate. Now, in this situation, by the way, don't ever not socialize this with your bank. Just say, hey, we're putting in a preferred instrument behind you and want to make sure this doesn't run afoul of your covenants. Bankers are many things. They do not like surprises, is one thing that all bankers have in common. They do not like surprises. Don't spring hey, we issued a bunch of new securities and didn't tell you. That never goes well. It's much worse if you issued a bunch of debt because they may blow a gasket, call a default, call the loan. But in the case you issue new preferred, you at least need to consult them.
You get free advice. So just remember, they're incentivized to give you money and for you not to default on your obligations to them. So they will tell you where the lines are in the game you're playing.
Yeah, and it's important to note that from the bank's perspective, the minute the money leaves the building, every action they take is to maximize the likelihood that it comes back into the building.
And they will help you. They will help you. They go, help me help you.
I mean, well, I mentioned I started my career in restructuring. I dealt with a whole lot of circumstances in which situations the bank was not sure the money was coming back. And oftentimes it didn't, to be completely candid, because sometimes the businesses were so poorly managed or market conditions turned so badly that they couldn't. But at that point, it's a negotiation with the bank about what can you live with. I would prefer for everybody who's listening to this podcast to never have to involve me or involve themselves in one of those conversations. Restructurings are unpleasant. The joke in the old days was, a successful restructuring closing dinner is the bankers and the lawyers and no clients.
Yeah. uh, okay, I want to wrap up with a little bit of foreshadowing. What we've spent our first episode in this series describing was what creative financing is relative to, within the US, the SBA function. Today, we've unpacked creative financing more and have introduced things that are not commonly understood in regards to your deal stack, your capital stack. And in our next episode together, because these are coming out in a series, we're going to sit down and go through a Q&A specifically addressing the questions from our agency M&A Slack community about creative deal structures with SBA considerations, without them, cross-border. We're going to go into a lot of details. So in between these episodes, if you have questions, please reach out to Peter and I. This is Peter Baldwin, Peter Lang on LinkedIn. Tell us the questions. Tell us the things that you've used. We are deal junkie nerds too. And at the end of the day, our pattern recognition has gotten to a really solid level, but people are doing creative things and coming up with ways to mitigate risk and using sources of capital and sources of funding that, again, always make us excited to see them used. So
there's no monopoly on good ideas. I always welcome input, and I have no pride of authorship from my perspective. Good ideas are everywhere, right? And I love hearing from people who have found creative ways to solve problems because it creates a frank exchange and an ability for us to help make each other better. And my goal at the end of the day is to be able to bring more resources to bear for my clients. And I presume that for anybody who has those ideas and wants to engage in that discussion, they feel the same, right? The idea here is to add more value to those who depend on us to help add value.
100%. We'll see you on the next episode in the series.